I love LinkedIn. Facebook is better for advertising to get leads, but LinkedIn is far better for developing professional connections and establishing relationships. And today's episode is entirely thanks to Ryan Mueller, who messaged me on LinkedIn to introduce himself, his company, and my guest today, Peter Auerbach, founder and CEO of Auerbach Funds. Now, Ryan was kind enough to share with me that he's been listening to the podcast when he goes running, which is really cool. And in fact, I did give a moment's thought to recording this entire introduction in a running cadence, but I gave up. It didn't sound too good, so I'm not going to even try to do that. And I must confess also that when I work out, I like upbeat country music. The lyrics are often hysterical, and I'm never sure if they're joking or if they're being really serious about it. But it was when Ryan told me that Peter was a seasoned opportunistic real estate investor that the euphemistic bells went off, and all I could hear was that they are experts in distressed real estate. So what you're going to particularly enjoy about my conversation with Peter today is that he is a phenomenal educator, very knowledgeable and experienced, and understands how to break down complicated concepts into discrete ideas that are all easy to consume. It's the epitome of successful online communication, in fact. Take a concept, break it down into its component parts, and create content from that in soundbite pieces, all that point to your website using links on social media. In fact, it's exactly how we produce these podcasts. We break it down into what I call notable quotables, quotes from my guests, as well as into short videos that we publish and distribute on social media, and every single one has a link back to the website. In fact, we're about to launch some new training that shows you exactly how to build that kind of content yourself. So if you are interested in that, be sure to sign up for our newsletter at gowercrowd.com. And in due course, I'll send you a link to the Equity Ignition training where you'll learn exactly how to do what Peter does today, right? Articulate ideas clearly and succinctly, and then distribute them in short, easy to consume bursts online so you can attract prospects and convert them into being investors or customers or clients with you. You'll find the newsletter sign-up options on the homepage at gowercrowd.com, and there are options for both developers raising capital and for investors looking for opportunities. So pick whichever best suits you, and I'll get you some more information right away. Now, I do have to mention that in the few seconds after we started recording, but right before we started speaking, because these are video podcasts, Peter Auerbach, CEO and founder of Auerbach Funds, my guest today made sure to fix his desk so that the picture of him and his wife was showing prominently. So, as I conclude this introduction to the episode, that's exactly where we come in now.
That is the best, most important thing in my life. No brainer. Anybody that knows me knows if you want me to be like you, if you're nice to my wife, you can get anything you want.
Good. Well, that's a great place to start, Peter. What a pleasure to meet you. Thanks so very much for joining me. We have to give credit to Ryan for setting it up. What a nice fellow. Before we start, I want to quote to you, if you don't mind, what it says on your website, and then I'm going to ask you a very important question about that. This is what you do. Real estate private equity fund manager focused on value add and opportunistic investments throughout the United States. Question: what are opportunistic investments from the Auerbach perspective, please?
So you could break it down into 4 categories: incorrect pricing, mismanagement, needs a cash injection for rehabilitation, and then we could add in a COVID-related short-term problem.
Right, but what you're doing is you're looking for properties that are undervalued because they have some kind of problem, right? Another term for opportunistic is distressed.
Yes.
Is that right?
Yes, and it could be properties or ownership. In some cases, you could have an excellent property, especially in times like this, where the owner owned all hotels somewhere else and now needs a liquidity injection and needs a reliable source of capital to quickly produce an exit for him.
So what do you guys do actually? You told me a minute ago that you'll send out an email and get $15 million without even a pitch deck, right? So I want to know what a guy like you does with $15 million when you send out an email.
I think it's best to be instructive because a lot of it has to do with past performance. So let me give you a little background about who we are, what we do. So we are Auerbach Funds. We were founded in the beginning of 2016. We have 3 closed-end private equity funds under management. $300 million in assets, 3.5 million square feet, 2,600 multifamily units. We've done 23 transactions in 8 states. We look for, as you said, underperforming, mismanaged, and distressed assets. It should be worth noting that we are an allocator fund, and as such, we provide 90 to 95% of sponsors, which are your listeners, to effectuate business plans in an LP structure. We target a gross 18 to 20% IRR, including a 7 to 9 net cash flow to our investors. To date, just to show that we do know somewhat what we're doing, our Fund 1 and 2 investors have had the following terms net, respectively, after our fees, sponsor fees. We have had 46 consecutive monthly distributions in Fund 1, including during COVID, for 28.89%, not including equalization, which is also added for our day one investors. Also, on top of that, we believe that there's another 21 to 25% in appreciation remaining net. Fund 2 is a little shorter. We've had that a little less, 11.01% thus far in 13 consecutive monthly distributions net, and an additional 10 to 15%. As I said, our strategy has allowed us to have the cash flow necessary that we have continued our consecutive monthly distributions through the COVID pandemic. So how do we do that? So again, as an allocator fund, you really—
Tim, I'm going to stop you right there, right mid-flow. What is an allocator fund?
Sure.
We got to really drill down. Don't be afraid of detail. What does that mean exactly? Right? You're not buying the deals yourself, are you? You're you're financing other people that are doing it, right? You've got a stable of sponsors, etc. Tell me more about that.
Every real estate deal has 3 components: the sponsor, the money, and the lender. The sponsor is your audience, the guy you know as the real estate guy, does all of the renovations, is on the ground running the deal. They don't have all of the money to put up their 20 to 50% of the capital stack. They will go to either friends and family or an equity fund such as ourselves to provide that equity. Friends and family is different from an allocator fund. In friends and family or syndications have 0 control. Whereas an allocator fund, similar to Brookfield, Angelo Gordon, and Blackstone, all run allocator funds. They are equity funds. We do control the deal. We have major decisions such as selling, financing, marketing strategies, construction, renovation, and in fact, even down to the website.
Fascinating. And that's because you provide the bulk of the equity, presumably.
That's correct. And typically, we are accretive to a deal. If you syndicate a deal, those syndicated parties will not be able to add value. They're not going to help you with a lender. They're not going to help you with legal structures. Typically, larger deals that need to be effectuated fairly and quickly rely on allocator funds, family offices, trusts, and endowments.
And so, but you bring added value as well. You're not just writing a check and
That's
taking
correct.
some of the big major decision rights, essentially.
That's
but you're
correct.
also assisting with the workouts as well?
Yes, we assist with the workouts, but more importantly, you have a certainty of execution. We spoke a little about crowdfunding, which I have never endorsed people to do, is if you're selling a deal and you have 2 options, operator 1, who has crowdfunding that's going to take 120 days to close, may or may not have the financing, or somebody with Auerbach Fund, Opportunity Fund 3, which we're on right now, as their partner, you will likely know who I am. The lender will know who I am. And while I won't pay you as much, you will have a certainty of close.
That's interesting, right? And then as far as the deals that you look to invest in, talk to me a little about the amount of debt that you allow on those deals. Because when you're looking at a distressed deal, clearly there's going to be some challenges with traditional bank financing by definition of the status that they're in. So talk to me a bit about your capital stack in a typical deal and how that rolls out.
So it varies. Let's start with a distressed deal. Distressed deals are usually cheap, not cash flowing. Therefore, your leverage is going to be a lot tighter. Your options are going to be smaller as well. Whereas in a standard value add deal where you're doing a light renovation on a unit, you could have anywhere from local lenders, debt shops, bridge lenders that will transition you into Fannie and Freddie loans, and it runs the gamut. On a distressed deal, you're looking at hard money lending, or you're looking at a local bank that you have a relationship with. Again, distressed deals are really for the pros.
Why?
Very much. I like to think so.
Yeah, but why? I mean, I know why, but why? I want to hear why you think.
So buying a distressed deal, and thinking about it before we spoke, is akin to, if you say, how do you buy a distressed deal? That's like asking me, how do you score the game-winning three-pointer in Game 7 of the NBA Finals with 3 seconds left? Now, if I were to answer you and talk mechanically and say, well, you bend your knees, make sure your elbows aligned, flick the wrist, and drain it, that would be doing a disservice to the steps that were required to put you in a position to effectuate the mechanics of that shot. So to be in a position requires 6 characteristics. 1, capital at the ready. 2, experience. 3, relationships in the local area. 4, legal expertise. 5, lending relationships and experience. And 6, and most importantly, reputation. So we could go through those, which will be instructive. In terms of capital, somebody that's distressed needs money today. If it's a distressed seller with a good asset, they need money. They are getting rid of that asset. Another way that could happen is if the seller is out of money to finish renovations and their bridge debt has come due. You need to be at the ready with your capital. Funds like ours have committed money. Going to raise it from friends and family, if you have the time to raise it, it's not really distressed. Or it could be distressed, but there is something else. People always assume that distressed deals are going to come back to normal. You have to ensure that the catalyst for those distressed deals is going to go away. So for example, if you're in an area that has been suffering from COVID, but you have a thesis that COVID will be finite, and at one point we will return to some level of normalcy. You know that catalyst is going to go away. On the flip draconian side, if you bought an asset, if you see an asset next to the Chernobyl power plant, well, that's not coming back. That is a permanent distress. So you need to differentiate between temporary distress and permanent distress, and make sure that you can cure that distress by effectuating a business plan, that you are trying not to rely on other sources that you can't control. There's obviously things that you can't control in life, but you want to limit those as much as possible. So that's capital. Experience. Distressed deals are typically not marketed. And if somebody says, I have an off-market deal, here's my pretty lender book.
Pitch deck.
That's not off-market. When you get an email flyer into your junk folder that says off-market deal in all caps that reached your spam, I don't know what to call that, but it looks like it's marketed. So real distressed deals, no fancy pictures, bad financials, no lenders lined up, no war room. So you really need to know, based on a limited amount of data, what you're getting into. You could have roof, structural, grading, violations, variances, pending evictions you can't control. These are not things that are going to be spelled out for you. So you need to know what you're doing.
Yeah. You want deals with hair on them, basically, right?
Yes. Yes.
So let me ask you,
need to be able to uncover that hair.
so we are, and actually shave it off as well to kind of continue the metaphor. But moving away from the barbershop for a moment, there is a fundamental difference, isn't there, Peter, between the downturn now, and you've alluded to this. You talked about Chernobyl. Obviously, it's not Chernobyl, but there are some qualitative differences between the downturn this time and the last downturn in 10 years ago, however long, 2007, 2008, and the few years after that, that have caused certain asset classes to become redundant. It's the wrong word, obsolete, or at least certain components of certain asset classes to become obsolete. So how are you seeing distressed deal resolutions playing out where it's so hard to see what that morphic, how assets are going to change in their usage patterns going forward? How are you dealing with that?
So the current pandemic, I think, was more of a catalyst or an accelerator of trends that we were seeing already. For example, we don't own a single office portfolio. Of all those square feet, or sorry, a single office deal, we believe that office was, for the most part, very oversupplied, in some cases redundant, as you said. That was accelerated and brought to attention. Retail, in some aspects, has also suffered as well. Not so severely of the redundancies of office. We're office oversupplied, but retail has definitely suffered. Things like hotels and resorts is not Chernobyl. That is not permanent. There will be somewhat less travel in corporate hotels, and resorts will certainly suffer because of the cost of goods and a global economy. More people have a pool. Going to the resort and sitting by the pool is not so much of a breakaway from your daily life as it used to be. We can do a lot of things from home, but I agree. So things that I would avoid in the long term are office. That is one of those, even if you could buy it really cheaply, it's one of those Chernobyl types that, obviously not Chernobyl, but it's not coming back that quickly.
Even though you're sitting in one.
What's that?
Even though you're sitting in one.
But to give you an example, we're monitoring $300 million of assets in 3,000 square feet of office, whereas before there were a lot more tasks that have been replaced by computers. And we could go off fundamentally on why that is and be futurists, but office is oversupplied. There's a difference between oversupply and not needed. Office is oversupplied. We have more than we need.
All right, so let me ask you this. So what are you seeing? And we talked about what it was that you wanted to talk about during this podcast. And I've already forgotten because I'm that good of a listener, I'm afraid. So hopefully we'll get back to it in a second. Don't be shy to remind me.
But one of how we raise money.
I want to know that, but yes. But what I want to ask you is this, and I think this is down your fairway actually, is so what kind of the deals that you're seeing now, and just to understand, just to reiterate how I understand you operate. Sponsors, operators bring you deals. They might find deals themselves that they want to buy and capitalize distressed deals, or they may be a distressed operator that comes to you with something, but that's the way the deal flow comes to you. What types of deals, adaptive reuse deals, if any, are you seeing now that is unusual because of the way that real estate is being used? And by way of example, what's in my mind, and this may not be on your radar, this kind of thing, but by way of example, the way that some big box retail is being repurposed into last mile warehousing, for example. So are you seeing deals like that? Is there a particular type of deal that you like, that you're actively seeking?
what we try to do is not hit the home runs. So what you're seeing a lot of in the adapted reuses is existing owners having to audible. They're at the line, the defense is coming in and they have to audible, or somebody has
They have to what?
audible. It's a football term that you change the play at the line of scrimmage. That's
Yeah, you
American
can't speak
football.
foreign languages to me. I only speak English. All right, you got to change the play. Okay.
They got to change the play. So you'll see a lot of student housing deals trying to turn into multifamily. They're losing money that way. We are not seeing many, and we're not comfortable yet. And we want to see what happens in buying something with a plan for an adapted reuse unless we add a tenant. They're expensive. They're not certain. And we want to ensure that the reuse is long-term reuse. So is retail, how much is retail going to die? Is it going to die a terrible Sean Bean death, or is it going to die a moderate death? So it's left to be seen. But the way we look at our investors is wealth preservation. We don't gamble. And I think that at this point, taking an adaptive reuse on one side, when I could buy a multifamily deal from somebody who ran out of capital, and I know people are going to live in apartments, that is a safer bet. Real estate has been lumped in with private equity returns, which it shouldn't have been. I think that the cap rate compression has elevated a lot of people's deals, and they've lost track of what real estate is supposed to be. In my opinion, you should never lose money on a real estate deal. I find that unacceptable. We've never lost money in 23 transactions, and including in that 170 single family homes, which is part of a portfolio. Even on those homes, we have never lost money in a real estate deal at Auerbach funds. So the reason why is we don't go swinging for the fences. So the adapted reuse is more for the existing owner. I would be cautious unless you had a tenant. One thing I could say is if you have Amazon in your hand for last mile, and while you're under contract, you could get them to sign the lease. That's a different story. Now you have certainty. But you have to ask yourself, why wouldn't the last guy get Amazon? Those are more rare. It's, I always say opportunism in that regard is not a business strategy.
So how do you
Really not
find, with as much liquidity as there is in the market, Peter, I mean, the world is different again than it was 10, 12 years ago, dramatically. There's enormous amounts of liquidity. Multifamily is without doubt the single most attractive, popular asset class. So how do you identify, how do you cut through the noise, or in order to be heard by distressed deals out there? As I mean, how do you find deals is what I'm getting at, especially in an asset class that is so unbelievably high demand and well financed?
3 ways: relationships, certainty of execution, and size. Relationships are important. And when I talk about relationships, not meeting somebody at a networking event, meaningful relationships with people that you've done deals with, worked on till 2 a.m. for years. Those are the relationships that will provide you deals. Meeting somebody at a networking function, typically the people that have access to these things don't go to networking functions. That's just not what they do. It's on the ground lawyers, on the ground sponsors. So that's one. Number 2 is we need to stay in a small size bucket. You talked about how there's a ton of capital in these markets. We write $3 to $10 million equity checks. What's interesting about the capital is there's a lot of capital going to very few sources. Similar to the stock market, where it was driven up by FANG. Those stocks, the alphabet stocks, the tech stocks, driven the entire market up. And when those went down yesterday and continuing to go down today, it drove the whole market down. So you see a proliferation of capital in the large groups looking at large deals. We stay in the shallow waters where there is not as many eyes looking at those deals. Further, with a smaller fund like ours, we can make decisions quicker. We don't sit through a lot of boardrooms, so we have access. But again, you need to be ready to go.
So when you talk about $3 to $10 million equity checks, typically, how big are the deals themselves? What kind of leverage are you looking at? I mean,
So
obviously that's how long is the length of string, but generally.
anywhere from about 10 to 25 million. Sometimes on a $10 million check, you might get upwards of 30 some odd million. You will take out leverage dependent on the security of the deal. If you are stealing a multifamily asset, it's really not going to be on a loan to value ratio. It's going to be on a debt service coverage ratio. What can I cover my debt at? We are market agnostic to a degree. We like to produce in all cycles. And the way we do that is based on stabilizing to a specific cash flow. If you value your assets stabilizing to a specific cash flow, you are less worried about a loan to value constraint, but a debt service coverage ratio constraint.
Right. That's debt. In other words, you're talking about not being over leveraged in simple terms, right? Basically.
Yes, or breaking it down between loan to value versus debt service coverage. Someone might ascribe your value as low. So if you have a lot of cash flow every year and someone says, well, this asset's worth less, if you're in New York City, Los Angeles, Miami, Washington, D.C., buying at 3 caps and all of your value is effectuated on a capital event, you're going to be in trouble. But if your value is extrapolated from cash flow and you're making 12% and somebody says that asset's worth less, well, you could sit there making 12% until it's worth more.
Peter, are you driven by, and I'm writing questions as fast as I can type it. That's all I'm doing is tapping because I want to talk to you for hours and hours, but I know we've got limited time. Are you yield or so you talked about wealth preservation, which is very important. It also implies that you are driven by yield in part. But tell me a little bit more about kind of financial strategy for somebody that wants to invest with you. We'll get to how you get to investors in a minute. But for somebody that does want to invest, what is the value proposition beyond the asset class itself? How you, in terms of the returns?
Well, I told you I wouldn't pitch the fund. So the value proposition with investing with people like me and in our respect is competence. And there's an illusion out there that core assets, which are typically low yield, low return, a full office building is the most riskless asset. I tend to disagree. I think that a competently done opportunistic or value add deal has the lowest risk and the highest yield. For example, if you were able to buy a dollar bill for 50 cents, you'd have a very large return. Would you consider that high risk? Of course not. So what you do in wealth preservation, I don't believe it's wealth preservation to buy a Class A full office building making 4% with leases rolling and fully occupied. From day one, you are playing defense. We don't play defense, right? All that could happen to you is bad stuff. There is no piece of good news in one of these core assets. But if you buy an opportunistic deal at auction where you're the only one with cash, or you find an asset with 50% of its units down and you have the expertise to bring it up, I consider that lower risk. When you model these larger deals, you have nothing but downside. If you sensitize your projections the slightest bit. So wealth preservation does not come from development deals because you're synthetically, when someone says, well, you're building below replacement cost, that's an oxymoron. How could you build?
It's impossible. Yeah.
Impossible. When I see that,
Have you actually seen somebody say that we're building to below replacement?
Of course, that doesn't make sense. So we think that buying below replacement costs in waters that are not heavily trafficked, having disproportionate strength, gives us a lot of room to preserve our investors' capital. Number two, the cash flow model. Some deals might not cash flow right away, but the point of stabilization is not to say, well, I have a small spread over a cap rate, but to actually be effectuating true alpha. So, for example, when the pandemic hit, we had assets cash flowing that they could survive a few tenants. We didn't give any keys back. Out of our entire retail section of our portfolio, we lost one tenant for 1,200 square feet. We retained every single tenant because we were in a position of strength. If you overpay for something, you have no strength.
Peter, one of the competitive advantages, you talked about 3 competitive advantages that you have in finding deals, but there was one that you missed, and I'm interested in a little bit. Not missed for any other reason than we're talking a lot, but one that does strike me as being very important. That is speed of execution. You did mention, I can't remember if while we were talking now or before we started chatting, if you've got 120 days to close, it ain't a distressed deal. So talk to me about speed of execution. A deal lands on your desk. You've got a short window to underwrite and close on that thing in order to be able to demonstrate intent before anyone believes that you're going to close. How do you do your underwriting?
Excellent. So first thing you do is typically on a distressed deal, you want to look at this with an existing sponsor, somebody you've worked with. So you have existing sponsorship, underwriting, legal, research, and debt. So we'll start with the underwriting. First thing you do is you take your sponsor's model. You look at it and you say, assuming that everything was true, would I do this deal? And you talk with the sponsor, and assuming everything they say is true. And if you have enough expertise in this business, you will know, give or take, if what he says is true. And you could be forceful and say, listen, I'm going to assume what you say is true. I'll be upset if it's not. The next step is you underwrite it with your own internal models. You sensitize it to a worst case scenario and say, assuming that our worst case scenario is true and cap rates go up 200 basis points, we can't achieve the rent. Would we do this deal? Number 3, you check the local market. It is very risky to be a market maker. You want to ensure that the assumptions in your model are at current market rents. A lot of people get in trouble and say, well, the market's going to go up. Don't bet on it. You can count on it and you're dead. You can best thing you could do is say, listen, this would be an upside case, and you don't tell your investors the upside case. You tell your investors the worst case scenario from day one. Transparency from day one, alerting bad news. That's a different subject.
Yes, and it's
the next is the legal team. So we would have an all hands on deck call, and instead of being the new sponsor that says, hi, I'm Peter Auerbach, I want to buy a deal, what does your firm do? Those are guys that don't get the stress deals. What we do is we say, hey, Janice Schiff at Holland & Knight, who handles all of our legal, I'll give her a little plug. Janice, we got something in Atlanta. Let's get Darian and Meg on the phone. I want to run through this with you. Who do we know down there? What are we going to get going? I remember the last deal we did, we spoke to X, Y, and Z. Next thing you do is you call your construction managers that have done deals with you on the phone. Say, I want to know about this asset. Run a scope right away. Let's make sure we have no leaks, no plumes. I want to know the structural because they're not giving us anything. So those are the nuances. You are ready to go on day one. Then what you'll want to do is you'll want to talk to the brokerage community right there, and it's a two-way street. If you are honorable to people throughout your career, they will put in a good word for you with that seller. Remember, the seller needs that money. They want to know you're a sure thing. So it'll be a two-way street. Mr. Broker, tell me about the history of the deal. Mr. Broker, please let them know we're looking at them. Let them know who we are. Now, if you've never closed a deal before and you don't have a track record around the country, you're not buying it. So that is a very, very fast talking, rudimentary way that we do business.
Good grief. I think that was me making that ghastly noise. I'm so sorry about that.
I didn't hear it.
Good. Maybe it's just in my head then. No, I'm kidding. Peter, we're going to have to wrap up, I'm afraid. And not because I've got a call coming up, but because I am afraid that I would like to talk to you for a lot longer. Let me ask you some final wrap-up questions. There's one very important one. Then I have 3 sign-off questions. And then I have to ask you a question offline. Right? So we're going to ask, I want you to pitch. And I'm going to tell you why I want you to do that, even though you don't want to. But we won't put that in the podcast. My last kind of substantive question before we get to my sign-off questions is, do you buy non-performing loans?
We have not yet. I have in my career, and in fact, one of the best deals I ever did in my career was an NPL, but I did it as a three-way close. So we foreclosed at the closing. NPLs are a good business right now, unquestionably. We don't do that. We know people who do, and we could recommend them. Again, expertise. This is a market, and I cannot emphasize this enough for every investor, every sponsor out there. Know what you're doing and invest with people who know what they're doing and are transparent.
Okay. 3 sign-off questions that I ask all of my guests.
Lightning round?
Lightning round. Yeah, lightning round. It's a lightning round. Actually, yeah, exactly. So first question. What are your key daily habits that make you successful?
My wife, every morning, best thing to happen is seeing my wife. And every night, 7 o'clock, I play 3 songs on the piano for my son. And then my daughter and I read together. From 7 to 8 is nobody bothers me time. And then I always have to watch a half an hour with my wife. And the habit that keeps me honest is every night I ask my wife the same question: am I a good man? And that's where I derive my strength to keep me going. Those 3: seeing my wife in the morning, 7 o'clock with the children, and that. They're not work related, but everybody is making that stuff up anyway. So
that's very moving, actually, and quite unusual. Thanks for telling me. Second question.
My team's going to yell at me for that answer, by the way.
No, not at all. You'd be surprised. You know, it's the most powerful form of communication is the most personal and the most authentic, period, right? Second question. This one is a business question. What has been the hardest lesson you've learned in real estate during your career?
I would say the hardest lesson is how to deal a hotel deal, which was a great concept. This was 8 years ago. And we got out of it pretty okay, considering. But management businesses, such as hotels, senior living, and student housing, are not real estate. They are management intensive. They are businesses guised as real estate. So your sponsorship is much more entrenched. And you have to really focus that if you're going to venture into one of these classes, you want to ensure that your management is strong. That was a tough lesson. Great idea, tough management. Good guys, just couldn't manage it, couldn't get it together.
It's like running a business.
It is.
The last question, last of 3, advice to somebody looking for opportunity, an investor. So we're talking now about retail investors and my whole business in crowdfunding. So for an investor looking to invest in commercial real estate today, what advice would you give to somebody looking to do that for the first time?
I would say to watch your returns. If the returns seem too good to be true, they are, number one. Real estate is not buying Tesla or Amazon or Zoom or Wayfair. It's a wealth preservation asset class. And go in knowing that this is your safe house of money. If you go in with that expectation, that will be the direction or the compass that will likely lead you. If I had to give one piece of advice, is to focus on your wealth preservation. Know your expectations going in. That will steer your ship in the correct direction.
Fantastic. Peter Auerbach, thank you so very much for your time with me today.
Thank you so much for having me on the show. I was very flattered.
That was Peter Auerbach, founder and CEO at Auerbach Funds. As I mentioned, we are about to launch some new training for both developers and investors, actually. So be sure to sign up for my newsletter at gowercrowd.com, where there are options for both developers raising capital and investors looking for opportunities. So pick whichever suits you best, and I'll get you some immediately actionable articles and other resources right away. That's it. Thanks for listening, and thank you so much, Peter Auerbach, founder and CEO at Auerbach Funds. I truly could have spent and would love to have spent much more time talking to you. Thanks for your time. As much as you were able to afford me, it was a real pleasure. That's all for this episode. I'll see you next time, and in the meantime, stay well, and for now, this is Dr. Adam Gower signing off.